Bill Clinton is famous for saying that when he comes back in a in a future life, he wants to come back as the bond market. He learned in his two-term presidency how important the bond market is and how you do not want to annoy the bond market because it will come back and bite you in the butt. And so, what I want to do is talk a little bit about the bond market's relationship with the stock market today. Hey everybody, this is RC Peck with Fearless Wealth. And this week's theme is a little catchy, but this week's theme is do not ignore these three charts because I think a lot of people do ignore price charts, or they don't quite understand price charts, and they certainly don't understand kind of relative differences between price charts or ratios. So I want to show you three charts that I think are very, very important and tell you what possibly you want to take away from them. Now, the first one I want to show you is a price chart of the 10-year yield. So what you're looking at here is what the 10-year Treasury or what the 10-year U.S. Treasury is yielding. So as of today, it's yielding 2.58%. So you give your money to the U.S. government, and they're going to give you back, let's just round it up to 2.6. They're going to give you 2.6% a year for 10 years. Pretty bad investment. Now you see two horizontal lines. One is below the low of October and July of last year. And that's about 2.45%. It's not that far away from where we are. And if the 10-year breaks below that, what that's basically saying is more people are going into bonds because as the yield goes down, the price goes up. So as people move into bonds, the general consensus is, and this is kind of my belief too, is people are more concerned about the future, so they want to put more money in a place that is quote unquote safer, I'm using air quotes there, than say the stock market. Now, the next chart, and I only have three charts I want to share with you this weekend, is the yield of the 30-year U.S. Treasury. Now, notice this, it has broken down. The 10-year didn't break down. The 10-year is still in that trading range. Look, I'll just go right back to the 10-year. See, it's still in that trading range between kind of 2.45% and 3%. It's still trading between those numbers. But the 30-year yield has broken down. You give money to the U.S. government for 30 years, and they're going to give you 3.37% a year for 30 years. Now, this is the same government, by the way, that has printed $3 or $4 trillion and has another $4 trillion of deficit spending. Okay, yeah, I know, it's the same one. So you're looking at about $8 to $9 trillion of money that will really never be paid back with the same purchasing power that it was spent at the beginning. So the 30-year is breaking down. This means people are getting a little concerned about the future. They're not getting concerned about the past, and they're not getting concerned about the present moment. They're getting concerned about the future. This is really a big reason why people put more money into the bond market, again, because it is quote-unquote safer. So notice people are putting money into the 30-year. They're pushing the price up, which pushes the yield down, which you see on the screen. The yield is falling on the 30-year, not yet on the 10-year, but the yield is for sure falling on the 30-year. Now, look at this here. This is a really cool price chart that I put together for you. Now, this price chart goes back to the beginning of 2005. So we have quite a bit of data on here. When the line on this price chart goes up, as you see here from 05, 06, 07, and no, stop going up in 07. When this is going up, that means more money, generally speaking, is flowing into stocks. More money is flowing into stocks. Now, here's what's crazy. Now, look at this screen here. I put a little red diagonal line on here for you, but notice that at the end of 2007, and really the peak of more money flowing into stocks happened in the middle part of 2007. So from the middle part on, the second half of the year, more money was flowing into bonds than stocks. Now, none of us really knew this because, well, none of the public really knew this because they weren't really seeing the ratio between where money was flowing. But this chart shows you where money is flowing. And from the middle or the second half of 2007, you could tell that money was flowing more into bonds. People were getting concerned. And we're talking, hundreds of millions collectively of people, because money managers of the bond market, they manage money for very large pensions, and it represents hundreds of millions of people. And then really money started flowing into the bond market. Now, the stock market didn't really collapse until about September, October of 2008. But notice by that time, more money had been flowing into the bond market for over a year than the stock market. And then, of course, the stock market just collapsed, and money was just absolutely gushing into the bond market and gushing out of the stock market. And then here in October of 2009, money then started flowing much more into the stock market, more into the bond market, more into the stock market, more into the bond market. And then from really the latter half of 2011, money has been flowing more into the stock market, and that stopped on January 1st of this year. So since this year, more money has been flowing back into the bond market. People are getting concerned again. Now, even though the market is up about 2% for the year, which, all things considered, it's still positive, but people are getting more and more concerned. So what I think is so great about this chart and so neat is it's almost like a crystal ball. It will show you if this line starts to break down below that line and that line, that means more money is flowing into the bond market. Not that the bond market is perfect and they always know, but that means more and more concern is going on because people are flowing more money into the bond market, pushing the price up, which pushes the yield down. Now, here is the point of this week. The bond market is much smarter than the stock market. And if there's a problem, it will most likely show up in the bond market first, with people putting more and more money into bonds. And I'm just using the 30-year bond as kind of a placeholder for the entire bond market, because the 30-year treasury for the United States is considered the safest investment on planet Earth. So it's not a bad place to look for if people are getting scared or not. And I'm not talking mom and pop getting scared. I'm talking money managers, fund managers that manage hundreds of billions of dollars collectively, if not more. So we can really learn a lot from where it's flowing. And I'll keep us up to date on that price chart if it breaks down, because it can really help us, really give us an indication of where things might be heading. So just, this is just another step to really help you take back control of your money and your future. You guys have a great weekend, and I'll speak to you soon.